From tech giants commanding trillion-dollar valuations to the Fed's influence on market sentiment, the U.S. markets are both a beacon of growth and minefield of uncertainty. On today's episode, we'll break down the forces behind today's market highs, along with the risks and the ETF strategies for navigating what's ahead. Chandler Nichols at Advisors Asset Management joins us right after this. Welcome to the program. I am Brittany Mason with ETF Guide, and it's great to have you with us. If you're new to ETF Guide TV, be sure to hit the subscribe button to join our community. Also, post your likes and comments in the section below the video. We enjoy interacting with our viewers. We're pleased to have with us Chandler Nichols, Vice President of ETF Product at Advisors Asset Management. Chandler, welcome to the show.
Thank you for having me.
There's a lot of questions from advisors and investors as to how they should be thinking about financial markets post-U.S. elections, along with Fed interest rate cuts. What asset classes might be an attractive investment choice given the changing environment?
It's a great question. It's a question we've been asked a lot by financial advisors, questions that a lot of investors are definitely wondering. You have now post-election, we now know that the GOP is going to be controlling the Congress, the Senate, and the executive branch. So having control of both chambers of commerce and the legislative branch will make it much easier for President-elect Donald Trump to pass some of the touted policies that he was discussing during the campaign trails. So tax cuts, tariffs, and deregulation were some of the main themes behind his economic plan. Some of those policies have the potential to drive growth. One thing that investors are concentrating on, and something that the Federal Reserve is going to be looking at, is what is going to be the impact on inflation. So kind of pivoting over to the monetary policy side of the discussion, since the Federal Reserve has cut interest rates in September, shockingly enough, the 10-year yields actually increased by 70 basis points as of this week. So the market is somewhat fighting the Fed. We'll see what ends up happening. There's definitely some questions to still be answered in terms of who ends up being comprised of the cabinet that President-elect Donald Trump ends up selecting, what ends up happening with how that impacts the policies that are taken into account first on day one and on his first day of office and through his first year of office. And we think moving forward, you could potentially see upward pressure on prices. You do have the potential for the opposite to occur too, because funny enough, during Trump's first term, core PCE was actually underneath that 2% level throughout most of his presidency. So we'll have to see what happens. But in terms of asset classes that we think could be fitting for this environment, one, low duration credit or preferred stocks to be more narrow. Low duration because taking a level of that bond market volatility driven by interest rate risk is something that investors ought to consider. And then in terms of the credit profile of preferreds, they tend to lean investment grade. They typically have yields that are above that of investment grade bonds. You have the potential of receiving a level of QDI treatment from dividends received from preferred stocks. And preferred stocks in general tend to be exposed to areas of the banking sector as well. So looking at the common equity side of things, banks actually have done pretty well since the post-election time period, so over these past few weeks. The other two asset classes that we think could be interesting for investors to look at are high dividend equities, those that you're taking a level of a value factor tilt implicitly by being exposed to companies with higher end dividend yields. In which the third asset class that we're looking at is small caps. So post-election, small caps have actually rallied significantly as well, potentially on the back of potential tax cuts. President-elect Donald Trump was touting potentially lowering the corporate tax rate from 21 to 15%. We'll have to see if that ends up happening, but the market is looking at this as a favorable potential trajectory for the small cap space. So those would be the three asset classes that we think investors may want to take a look at going into the post-election period.
Shifting gears, investors want steady income without any surprises, but changes in interest rates can have a dramatic impact on income paying assets like preferred securities. How does the AAM Low Duration Preferred and Income Securities ETF, that's ticker PFLD, deal with this, and what type of investor might the fund appeal to?
Yeah, so to take a step back and just go through PFLD from the top down, this is an index fund. So the goal of the strategy is to track an index, an ICE index, that effectively gives broad exposure to the U.S. preferred stock market, but particularly the lower duration segment of that preferred stock market. And the one screen that its tracking index implements that does this is its duration screen. So effectively, any preferred stock upon its monthly rebalance that has a duration above that of 5 years are effectively removed from the portfolio. So that allows it to concentrate more so on those lower duration preferred stocks. The coupon exposure of the strategy also exhibits this as well. Typically is balanced between that of fixed and variable rate preferreds, allowing investors to also use this as an evergreen strategy, not just a low duration component of a fixed income sleeve or of a broader multi-asset portfolio. But the other part of its screening process that we think investors might find attractive in the current environment is its call screen. So this is another screen that's added within the index methodology, in which upon a monthly rebalance, PFLD's index will remove any preferred stocks that are trading at a level of which is 105% or more relative to that of its face value. So you're eliminating preferreds that potentially have a higher probability of being called away. Now, to take a step back on the preferred market landscape, typically most preferred stocks are issued with a call option, which enables the issuer to call back that preferred stock, typically within a 5-year period. Typically, that first call date that enables them to do this isn't until 5 years down the road from the initial issuance date. Could go up to 10 years, though. We have seen that happen as well, and can happen depending on the particular issuance. So we think in a lowering rate environment, again, the Fed's cut by 75 basis points thus far, you could potentially see an increased potential of preferred securities being called away. Therefore, this screen potentially mitigates that risk, thus potentially lowers that reinvestment risk. Because from an issuer standpoint, if they're calling back preferred shares, they might be issuing newer ones at a lower interest rate given the more favorable rate environment. So we think that call screen is really important for this particular time frame, and it's impacted the risk reward profile of the product pretty nicely too. Typically has had lower standard deviations relative to that of other index based strategies within the marketplace. It's also interestingly enough has had a lower beta to that of U.S. equities, but also a lower beta to that of broader U.S. fixed income, which we think is interesting. Now, beta is just a term in terms of how it moves in relation to a particular calculation benchmark, but wanted to signify that as something that we think is intriguing, because it really shows that PFLD is a true hybrid asset and enables the investor to get something that can potentially differentiate their portfolio. So who we think this is fit for, to answer that last part, those naturally are still looking to maintain elevated levels of income potential by moving down the credit curve into an area like preferred stocks that can potentially be tax efficient based on the historical QDI treatment that preferred securities have enjoyed, but also within, just broadly speaking, from a total return standpoint, something that can maybe fit within a broader credit allocation within a multi-asset portfolio.
Moving along, U.S. equity market valuations have been another hot topic for investors. Besides generous dividends and dividend stability, how might a fund like the AAM S&P 500 High Dividend Value ETF, that's ticker SPDV, help alleviate potential market valuation concerns?
Yeah, so again, SBDV, this is another one of our index-based strategies here at Advisors Asset Management. It's actually one of our oldest funds here at the firm. It's celebrating its 7-year track record next week. So we're excited for that, but also excited as to what it could potentially offer for investors. It starts off with the S&P 500 as its starting universe in terms of the index methodology of that index that it's tracking, in which two screens are effectively two criteria are effectively enacted within the portfolio to filter through the S&P 500 for its final portfolio. One, high dividend yield as per the name, so utilizing dividend yield as that metric for the income component. But the component I want to concentrate on is the free cash flow yield screen that it also implements as well in order to calculate that final composite score. So free cash flow yield, we think, offers a twofold potential benefit when screening within an index. One, value offering a potential value factor tilt, but also a quality factor tilt potential too, because high free cash flow is potentially a nice way for companies to either one, pay down debt, maintain or increase dividends, or just reinvest back into the business in order to provide growth potential. So we like free cash flow yield as that particular screen there. And then in which once the composite scores for both of those calculations are effectively multiplied against one another to create that final score, we end up taking the final composite score for the top 5 companies in each GIC sector. 11 GIC sectors, 5 companies, 55 stocks total, all equally weighted. So you get even exposure throughout the number of securities per GIC sector, and you get that equally weighted as well, minimizing potentially some of that concentration risk that is found in the parent index that SPDV effectively filters through. So this has resulted in some nice tendencies for the portfolio to have elevated active share relative to broader U.S. equity markets, only a 6% overlap relative to the S&P 500. So we look at this as potentially, not only fitting within an income sleeve at a pretty opportune time given the rate environment, but also being able to offer that explicit value factor tilt given that free cash flow yield screen that it incorporates in the index methodology within a broader U.S. equity allocation.
One final question before you take off. Your firm offers the AAM Sawgrass U.S. Small Cap Quality Growth ETF. That's ticker SAWS. Why should advisors and investors consider SAWS over plain vanilla small cap index funds?
Yeah, it's a great question given the natural rise of index investing. But we think small caps in general are one of the more ripe areas of the equity market for an active solution. And it really comes down to a few things. One, a less efficient market typically has lower analyst coverage relative to that of typical of large cap U.S. equity universes. Also, I think this is probably what we think at least hits home with investors who are looking to incorporate small caps in their portfolio is that some broader indexes tend to have exposure to negative earners. So, for instance, like the Russell 2000, relatively speaking, 40% of the companies within there have recently have been negative earners. So we think an active approach that is quality driven, fundamental driven, can potentially thrive in a market environment of elevated interest rates in a period where small caps have gotten beat up, but if we could potentially see, you have the potential for a nice reversal of that trend given the current environment and the potential of some of the newer fiscal policies benefiting some of these companies. So we think a hands-on approach could potentially work there, and also kind of going into the specifics of what has occurred in active management in the small cap space. Morningstar actually puts out a really interesting study every 6 months called the Active Passive Barometer, in which they notated in their most recent report in June that typically the success rates of small cap managers have been higher than that of mid and large cap managers. So we think that sets a nice playing field for a small cap active manager to do well and thrive. And we think we have the best manager to manage and sub-advise this portfolio of SAWS in Sawgrass Asset Management. They've ran this strategy in the SMA wrapper for well over a decade. They've outperformed their benchmark in that wrapper, and they utilize 26 different fundamental characteristics when incorporating their bottoms-up fundamental approach in when they incorporate into their final portfolio. So we think active management can thrive here, and we think Sawgrass is going to be able to do an excellent job in managing the portfolio.
Wow, Chandler, you are a wealth of knowledge. I just want to say thank you so much for, taking the time today and dropping in and sharing all of your insights with us. So thank you.
Thank you for having me.
To learn more about ETF dividend income and growth investing strategies at Advisors Asset Management, visit aamlive.com. The link is posted in the description of the section below. And don't forget to subscribe to ETF Guide TV and tell us how you've been enjoying our timely programs like this one. I am Brittany Mason. Thank you so much, everyone, for watching.